We don't have ultimately a planning challenge when it comes to getting approvals, DAs. They are very, very slow. You could argue there is a planning challenge in the pace of getting approvals, but there are approvals out there. We have a cost of supply challenge. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into the demand and supply mismatch and why property investors need to know that eventually there will be higher prices. The math ain't mathin'. And today I just want to do a quick podcast on what that actually looks like, where we've come from, and where we are today, so you can understand really the metrics behind supply and demand here in Australia. Now, I've got a new angle. Anyone watching on YouTube, my 32 actual viewers on YouTube, I've got a new angle. You may see the new angle. I don't know if I like the angle, but yes, I have a new camera and a new angle. So hopefully you like it. It's my first time playing with this new camera. But hey, I hope everyone's well. I'm slightly hungover. Yeah, I had a few drinks last night, a few cheeky ones. So I don't know, is this my first hungover podcast? Very well could be. I'm surprised I'm able to talk, but hey, I can always talk about properties. The thing I love the most in this world. Certainly changed my life, and it's certainly changing other people's lives. And I think as an asset class, you can't beat it. All you can do is join it. But hey, welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And all the episodes I've done are lessons in one way, shape, or form when it comes to property investment. But as we know, there is a concept known as the bullwhip effect. And of course, the bullwhip effect is a fairly simple formula. If you don't put things at the top of the funnel, they're not going to come out at the bottom of the funnel. And of course, that creates a bit of a bullwhip effect, whereby economically speaking, someone gets lashed. And of course, that someone at the moment is the uninvested, and of course the rental market as well when it comes to just the devoid of stock. So I think if we want to explain where we are within the marketplace at the moment, we need to go back in time. Yes, let's travel back in time. Obviously, the last time we saw a surge on higher prices in general was the launch of the pandemic. Yes, the pandemic saw the Reserve Bank of Australia lower interest rates to record low levels. And of course, this was a significant situation for Australia because it created a huge amount of demand. People who had wanted to change lifestyle location, change house, upgrade their home, all of a sudden had an opportunity to borrow money at a low rate and basically upgrade their living experience. And of course, because of COVID, we also had a spatial transformation and a lifestyle change where all of a sudden we could arbitrage our lifestyle, live in an area we prefer, and work from home. And of course, given Australia's workforce is made up of a large part of knowledge workers, then all of a sudden demand drivers were driven through lifestyle and low interest rates. And of course, if you think about the most recent demand driver, it has been off the back of immigration. Australia grew by the size of Canberra in 2024. That's 500 odd thousand people. That's a lot of people to bring into your economy. And of course, that demand driver has ultimately created a bit of a mismatch. And of course, through the COVID period and even into 2024, you saw the higher prices unfold. And a lot of those higher prices, particularly later in the cycle, ended up going to places like Brisbane, Adelaide, and Perth. And earlier in the cycle, you had areas like Sydney as well doing very, very well. So as prices have risen, buyers have had to find more affordable places to shop. And of course, this has meant some of our smaller cities have done very, very well. But demand plays one part, but supply plays another part. And of course, if we were to think about where we are today in the cycle, we have much higher interest rates. And of course, interest rates at the time of recording may actually come down, but we know in 2025 they actually will come down at some point, whether you're listening to this recording, which should come out I believe in February or even March. There may have been a rate cut, but ultimately we know in 2025 there will be rate cuts. But they won't be cut to the point where they were basically during the COVID period. We may see 0.5%, 0.75%, and then that's where rates will go into a more long-term cycle. From a short-term perspective, certainly we're in a higher interest rate environment compared to what the cost of properties are and what our wages are. Affordability is a real challenge. And of course, because we have higher interest rates and because affordability is a challenge, and due to the fact we have a shortage of well-located land, which is quite unbelievable considering the size of Australia, but Australia is a very urbanized landscape. Australians live in very few places across this huge continent. And of course, places like Brisbane, Adelaide, Melbourne, Sydney, Newcastle, Geelong, they hold the mass of populace. And of course, through urbanization, there is ultimately a lack of well-located land. And of course, the biggest supply driver is construction costs. If it's inexpensive to build something, then you can build more of it. If it's costly to build something, then someone has to pay for that cost. And in real estate, that's typically a private person who is a developer, or in the home building market is typically a mum and dad building a home to live in, or even a property investor. So when construction costs are so high, what happens is it actually restricts the amount of stock being produced for the marketplace. And actually, right now, literally, if you take in last year's data and the current data, we are at an all-time low of production of property. And of course, you have to go back to 2014 to basically find figures this bad. But of course, in 2014, there were something like 2 million less people in Australia. So we have more people, less property, higher interest rates, and a higher rate to construct real estate. We don't have ultimately a planning challenge when it comes to getting approvals or DAs. They are very, very slow. You could argue there is a planning challenge in the pace of getting approvals, but there are approvals out there. We have a cost of supply challenge. So if you've got a shortage of well-located land, you've got high interest rates, which basically mean it's very unaffordable for people to buy real estate, and you've got a high cost to produce a new property, you simply have a mismatch of what people can afford to what can be supplied. By way of example, a property typically in new construction, in housing, you're not going to get much change out of $850,000, but the median income family can typically borrow about $700,000. So if the median income family can borrow $700,000, but a home costs $850,000 in the new construction market, you're not going to see a property be produced in new construction. And of course, if we analyze the new construction market, the market can be divided into two sections. Section 1 is the home building marketplace. And really the supply of home building homes is typically done at a 1-for-1 level. One buyer, one new home. You don't ever hear about an oversupply of brand new houses sitting within the market landscape. There's not 10,000 brand new houses out in the outer corridor of one of our major cities today sitting there unsold. Just simply doesn't happen. The reason being is you need a buyer to match the supply, 1-for-1. And of course, if there isn't the buyers, well, there isn't effectively a new house created. Of course, there could be land titled that is available to build on, but that is generally held by some large-scale public companies who simply, if that land is not absorbed, will not produce more land to then create an oversupply on their own land. They simply slow down the production rate. And of course, this creates a supply-demand mismatch. In other words, ultimately, there is not a lot of stock being produced. And of course, if you go to the other production of new supply, being the private developer, when they do their feasibility typically on the townhouse or apartment marketplace, and they factor in construction costs, planning costs, higher interest rates, and of course a shortage of well-located land to actually buy and redevelop, then all of a sudden when they look at development sites, they simply can't make developments work. Of course, this supply driver is actually a lack of supply. So even though today we're in a situation where demand is not high, because a demand driver is typically low interest rates, high immigration, and high lifestyle choices, supply drivers are actually keeping the market very buoyant. A shortage of well-located land, higher interest rates locking people out of the new construction market, producing less stock, creating a supply and demand mismatch. So what does that ultimately look like eventually? Well, it looks like higher prices. Of course, if you see later in 2025, the demand drivers start to improve, i.e. interest rates start to come down, people are not locked out of those lifestyle choices they're looking to make when it comes to upgrading the home, moving to a new suburb, buying into a better geo arbitrage lifestyle precinct, then of course you're going to get with that more supply and demand mismatch. And of course that will equal higher prices. The bullwhip effect is going to unfold. And when it unfolds, I can't tell you, I don't have a crystal ball. But when you take a lack of well-located land, you take an inability to produce stock in well-located areas, the lack of stock in the marketplace that is now at a 11-year low, you pile in more immigration. At some point, a lot of those immigrants start to leave the rental market and become part of the buying pool marketplace as they, become Australian citizens. And then all of a sudden, if you actually see the rates lower, even by 0.5% to 75%, you're going to see the ability for the market to move again, and those demand drivers will move in what is now a very undersupplied marketplace, and that pressure point will create a bullwhip effect of effectively higher prices. The bullwhip of not putting enough properties in over the last 5 years at the top of the funnel is now come out at the bottom of the funnel. If interest rates lower at the top of the funnel, that will produce buyers at the bottom of the funnel. The more buyers at the bottom of the funnel will meet the supply mismatch, the lack of product. When will that unfold? Well, I think you'll start to see rate cuts basically all start to unfold by certainly mid-year. And if you were to say when there's going to be a bit of a spike on prices in most urban areas, you would have to say 2026 looks like a spike of prices. In other words, we could have a little surge on prices, a mini boom, let's call it a mini boom in early 2026. What would a mini boom look like? It could actually see a price push of 10 to 15%. And of course, that means if you're uninvested or aren't controlling real estate today, again, it just gets harder down the track. And of course, if you look at the median house price today in Australia, across Australia, it's well over $1 million. And if you get a 15% push on a $1 million house, well, then it becomes a $1.15 million house. And again, we start to run into issues where a lot of people get locked out of the marketplace. So don't let that be you. If you're in Australia, you want to be invested, you want to deploy your money into the marketplace and get a result from it. And obviously, one of the results you can get from real estate is capital growth. How capital growth really works: demand drivers, supply drivers interlocking with each other, and you get the market cycle doing some growth. So interesting point. We are in the market, and I'm excited. I'm excited to buy real estate well this year and probably capitalize a lot on it in early 2026. I think it's one of the best ways to buy real estate is to plan ahead, plant the seed, and get the result. All right, well, that's it from me, your hungover podcaster. I'm doing a quick show today due to the hangover, but I think I did all right. I surprised myself. But I hope you're well. I hope you don't have a hangover. I don't really drink that much, but I went to a party last night and it was fun. So, don't shame me. Do not shame your podcaster. I am a human being. I am fallible. But it's been a pleasure, folks. I hope you're all doing well. And I can't wait to come back next week and do some more podcasting. Let's talk soon. Over and out. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.